right, today's financial education video is going to be about hitting the sweet spot with your portfolio. If you'd like to do that or you're curious to what that is, stay tuned because we're going to dive right into it. So if you've ever played golf, you know that it's really important that when you hit the golf ball, that you hit the ball right in the sweet spot of the club. And that's basically that spot, like right in the middle, because if you don't, the ball will just do all kinds of crazy things. And it's the same thing with your investment portfolio. You don't want to hit the ball right at the end of the club or way on the inside of the club, because it's not where you're going to get the most velocity for the amount of speed that you put into the golf swing. And so how does this relate to investments? Well, this is a chart here that shows different portfolios, and this is the risk here at the bottom and the return here on the vertical axis. And you can see here, I know the writing might be a little small, but you can see that 100% bonds, you're actually getting a lower return and and more standard deviation or risk than you would if you had a portfolio that had a combination of stocks and bonds. And you could see a 60-40 portfolio where it's 60% stocks, 40% bonds actually gets a higher return with about the same amount of risk and sometimes even a little bit less risk than if you were in 100% bonds. Now that's different from buying like a CD or something like that, but like bonds that trade in the secondary market. So what also happens is you can see here, the more you add to stocks, the more return you get, and that makes sense, but you get a lot less return per unit of risk. See how much further out you have to go in the risk spectrum for that to happen. And so when you really think about it, the sweet spot in investment portfolio construction is right around in the middle, just like with a golf club. And that's why I typically discourage people from going too far on the conservative end of the spectrum and too far on the aggressive end of the spectrum, because you're not maximizing the amount of return per unit of risk. And when it comes right down to it, that's really the key in portfolio construction. Okay, I want to expand on this idea a little bit more about slow and steady wins the race. Okay, we've all heard of the story of the tortoise and the hare, and we all know the tortoise wins. And the tortoise does this by being more steady and not getting lost or not stumbling and falling or anything like that. And so what I want to do is I want to show you something that most people don't understand about the underlying mathematics. I know, it's math. It's not the most exciting thing. But when you understand this concept, it's really going to change the way you look at your investments. Because here on the left side, we have the hare. He's fast, he's growing faster. And I did a hypothetical of different returns that actually average 7%. But what happens here is when you start with a $100,000 balance, and I believe this is 11 years of returns, you end up after the time frame with more money, which is nice, $169,000, as you would expect, because you were earning 7%. But who would have thought? Who would have thought that you could actually earn a lower return, okay, the tortoise here, slow and steady, and you have a similar dynamic in the returns just with less extremes, earn a lower rate of return, and look at that. You end up with a higher balance at the end than you did at a higher return. So if anybody asks you, could you actually earn more money by earning a lower average return? The answer is yes, you actually can. Because if you get those returns in a much steadier fashion, you compound on that money much better. You see, the biggest thing here with the hare is that he tripped over himself a lot at the beginning. And he made up for it at the end, but at the end, he had a lot less money to work with. This is why it's so important to not just focus on the average returns, but to focus on good, long-term, steady growth that can compound over time. All right, I just couldn't help myself. I had to throw in one more chart. This is kind of driving the same point, just done a little different way. When I was looking for a good chart for this educational video, I found this one initially before I kind of created my own. But this is really interesting too. In this hypothetical, of course, these are all hypothetical, right? There's 8.5 return on 3 different scenarios. So example 1, example 2, and example 3 all earn 8.5%, but they all end up with a different amount of money at the end, 22, 20, and 21. And again, what makes the difference here is the sequence of when the returns happen. You see, an average just adds everything up and divides by the total amount of occurrences. But it doesn't take into consideration when those negative numbers or big positive numbers happen. And so cumulative numbers do. And so again, the same thing can happen here. So again, instead of focusing on the average return, we need to focus on good, steady, long-term returns that compound over time. I hope this was helpful, guys. If you have any questions or you'd like to discuss or dig into these numbers a little bit more, you know, I'm always available for you to do so. But thanks a lot for watching, and God bless.